Welcome to System Trader Podcast. Listen to interviews with top traders and find out how the most successful traders beat the markets and what are the secrets of their success. This is System Trader Podcast with your host, Jack Lempart.
Hello to everyone. Today we have a very special guest, a very renowned trader, Linda Raschke. Linda began her professional trading career in 1981, making markets in options as a member of two exchanges. She became a registered CTA in 1992. Linda's hedge fund was ranked 17th out of 4,500 for best 5-year performance. Jack Schwager recognized her early success in his famous Market Wizard series. So let's move to the chart with Linda. Hi Linda, and welcome to my podcast.
Hello.
Thank you so much for having you here today. You are among the most renowned traders, so that many people already know a lot about you. Could you please, however, give us some short background of your trading career?
Well, I started back in 1981, so I guess I've been trading for about 37 years now. And I started as a floor trader making markets in the equity options when things were inefficiently priced. And that opportunity is no longer there. I guess you could say I've done a little bit of everything in terms of types of markets traded, and I was a CTA since 1991 and traded for several hedge funds, had my own hedge funds, and basically retired 3 years ago, but I still trade for myself every day.
Okay, thank you. So what is your current trading approach? I know that you're trading now on your private account, but have you changed anything within your approach since your retirement?
Nope, it's the same as it always has been. I am 100% technical in my approach, using price. I pay a little bit of attention to volume, but not a whole lot. That's just more to put it in the current environment. I find I get all my information from price. And of course, over time, you're just aware of little, small, seasonal subtleties and biases. But that's pretty much it.
So would you describe yourself mostly as a discretionary trader? I'm asking this question because...
Yes, I'm a discretionary trader.
All right. I'm asking because I know you're modeling the markets, asking questions, what works, what doesn't. Basically, you're backtesting some trading ideas. In other words, if I'm correct, you build quasi-mechanical systems, although you don't use them per se. How do you then use these models during your actual trading?
Yes, I don't build mechanical systems, but I do modeling, and I pretty much have stopped doing most of my modeling as of about 7 years ago. I feel like, I've modeled everything I can model, and the ideas and principles that I use are pretty durable and robust. So they serve me just as well now as they did 10 years ago and 20 years ago. So they just give you an initial bias, and then you see how the market behaves the next day in accordance with your bias and where the supply-demand imbalances are, and take it from there. So most of my modeling is just there to give me my initial game plan, if you will. But I don't really treat them as systems.
All right, I understand. You control everything by yourself. I mean, you don't, let's say, trust the system, so they're just telling you where you are.
Right. For example, in my modeling, I might ask the model, if I went long on the close and exited on the close the next day, what is my edge, or, what is the probabilities, or however I want to ask the question. So I'll do things from like close to close or open to close, or perhaps a breakout point intraday to the next day's close, those types of models. But if, during the trading day, I can get in better or I can exit better, which sometimes you do, sometimes you don't, then that's how it ends up unfolding. But they're not mechanical entries, but you have to have some basis by which to test your models.
Okay, I understand. Are you creating your models for a specific type of market mode in mind? I mean, bullish or bearish, for example? Or maybe you prefer to have, let's say, universal models for all kinds of markets?
No, I basically model structure, price structure and price behavior, and it doesn't really matter if it's the S&Ps or the cows or the Canadian dollar. Of course, individual markets have differences, subtle differences. You know, the cattle market's going to have differences than the interest rate markets, but it's just overall market structure. So if you think about the most basic type of technical analysis, higher highs, higher lows, or chart formations, support, resistance, increasing momentum, decreasing momentum, the degree of noise, just simple things like that.
And which markets are the most favorite ones to you?
I like the futures markets. That's what I prefer to trade. So the index futures, the currencies, the interest rates, the metals, the energies, the grains, these types of markets.
And do you like day trading, or maybe you leave some positions opened overnight?
I like making some day trades, but most of the money is made holding something overnight or being able to capture the trend for the day. If you've got the main idea right, there's no point in going in and out and in and out, just to show that you can make winning day trades. You're better off if you entered on the opening and exited on the close, especially on a day like Friday, which of course you never know in advance it's going to be that type of day. But I find a better edge usually in holding a position overnight or putting it on in the evening or, holding for 2 or 3 days, that type of time frame.
I remember that in the book of Jack Schwager from 1994, if I'm correct, you mentioned that your goal is to be profitable every day. Of course, in reality, it's not possible to be so consistent, I guess. Anyway, is it really still the case that you're trying to be profitable every day or every week?
Sure, but that's just talk. There's always unforeseen things that can happen. I think a better way of putting it is, just to approach each day fresh. How am I going to make money today? How are my positions going to work today? That type of thing. Instead of trying to look too far out in advance, like where is the market going to be a week from now or a month from now and predict. So instead of, trying to predict or forecast a level or a course of action too far out, I'm like, okay, I'm just going to deal with today and see how that plays out.
Okay, I understand. Could you please share with us a ratio between the winning and losing trades? I mean, do you have any goal here you want to achieve?
No, and I don't really believe in ratios of winning to losing trades, because if I analyze my own performance, I will find that the ratio, the percent win, is going to be a function of holding time. For example, if I'm holding trades for a duration of 2 to 3 days, my win rate might be 62%. If I'm holding something for a duration, let's say perhaps it's a pattern off of the weekly charts, which might only come along maybe once every 2 or 3 months, then I might have a duration, a winning ratio of 40%, and I might have to try several times. If I'm day trading, perhaps my win-loss ratio could be 85% or 90%, but that doesn't mean that I make more money with a high percent win rate. Trend followers can make a lot of money if the environment's right, and they might only have a percent win of 30%. So it depends also how tight is your risk management. Are you going to be quick to exit if it's not working out, but then try again? That's okay as long as it doesn't get to be over trading. So I really steer away from all those statistics like that. I don't think they really serve the trader.
All right, thanks, Linda. Let me go back a bit more to the topic of modeling and systems, as it's very interesting to me. I want to ask you a question. How do you reoptimize or adapt your models correctly? Because the markets are changing, right?
No, I haven't optimized or anything like that for 30 years. The reason is my models are pretty basic. I never use more than one or two variables and maybe one filter, so they're extremely durable and robust. I don't want a model that's only going to work in a particular environment like a bull trend. That's because it's very difficult for models to assess when that trend is changing, when it's starting to roll over or when the noise level is increasing. And then if you go down that road, you're just going to end up data mining to cherry pick one or two great trades in the middle of the trend, and then what happens is your trade frequency drops way, way, way down. So, no, I note how models change over time according to price behavior over time and people's behavior over time. So, for example, let me give you an idea. I remember modeling 30 years ago the percent of the day's range that happened in the first hour. And it used to be that the percent of the U.S. pit sessions range was about 40% occurred in the first hour. And then when we remodeled that 15 years later, the percent of the daily range, and of course this is over a very, very large number, so, over a sample size of 500 days, the percent of the day's range that occurred in the first hour had gone up above 60%. So obviously employing a strategy like a breakout of a first hour's range to initiate a trade was no longer so timely. And that's because the urgency, off the opening price and the inflows of money and increased bandwidth and so forth, had changed the efficiency level there. So that type of modeling tells us something, but it doesn't mean that we're going to necessarily, or I am going to necessarily change a strategy. I'm just going to make note of that. And I don't do breakout of first hour's range. I haven't done that for 25 years anyway, but it's just noting a change in the urgency. When you start modeling higher time frames and you do it over large sample size, I find that things really don't change at all. What changes is people's bias. People tend to remember the most recent events and overweight them. So they're not looking back how markets traded 20 years ago or 30 years ago or on the other side of the world. They're always going to be biased and overweighting more recent events. So people tend to not use large enough sample sizes in their own modeling, and it's human nature to try and want to put something in a black box, to try and engineer a perfect equation that you can solve. That's a bit of human nature, but the markets are not a closed universe. It's not a closed system, so you really can't do that. And, you have to accept a certain amount of things that are going to be well beyond your control. So I think that people tend to spend too much time modeling things, looking for predictions, forecasting, levels, these types of variables, and they don't really spend enough time modeling their risk management and trade execution strategies and trade management strategies, which are much more appropriate to deal with the type of data that we're dealing with, where you have very, very fat tails and low frequency of the events that impact the markets the most, which makes it difficult to model, right? So that was kind of a wordy response, but I hope you got the main idea.
Yes. Thank you very much, Linda, for sharing that. Actually, I wanted to ask you how to cope with data mining and curve fitting pitfalls, but you've just answered that question, at least to some extent. System traders are facing that problem very often when they test the models very heavily, when they heavily adjust the models to the historical data. And of course, they get a very nice looking results, but it doesn't work in reality. How do you backtest your models so that you're absolutely sure that what you see is not a data mining bias or simply curve fitting? Do you have any specific procedure here?
Well, there's two things. First of all, again, back to the thing of sample size. And usually when we do our modeling, we do it in 3-year blocks, those 3-year chunks. So let's say I'm modeling something and I'm looking at the data for the nat gas market. I'll do it 2000 to 2003, 2003 to 2006, 2006 to 2010, basically 3-year blocks so that I can see if there was a bias, for bull market, bear market, how it changed, stuff like that. And then I always do a portfolio. So I look at 20 different markets and I say, is this working across the board? Is there a commonality here to that? So if I have 20 markets and I'm modeling something, I might see that 18 each year are profitable and 2 are not, and so you can start to see the nature and the personality of the individual market. So that's one thing that I find it has to work on, multiple products, different environments, so forth and so forth. And then the other thing is that you want to make sure that your model works across a spectrum of parameters. So, for example, I'm going to test exiting close day 1, day 2, day 3, or open day 1, close day 1, open day 2, close day 2 type of thing. And I want to see some type of positive expectation across several different exit strategies. Maybe one quarter, one strategy might be ideal, and the next quarter, a different exit strategy might be preferable, but I want to see that there's a positive expectation across multiple ones, you see? So, and that changes from quarter to quarter, and it changes from year to year. Same thing with, let's say you were just doing a basic generic trend following system per se. I want to see that if I was entering on an 18-day breakout versus a 20-day breakout versus a 22-day breakout, that I would have a positive expectation in any trigger point, and of course how you manage it is going to be another thing. So I think that's really important, that you want to look at your models and say, okay, are they going to work across a broad variety of parameters? And then that's what builds your confidence level, and that's also what makes sure that your models are going to be durable and robust. And I think those are the most primary considerations, in our markets that we have.
Thank you, Linda, for that. What's your opinion on techniques like walk-forward analysis or Monte Carlo simulation, which are often used by traders using mechanical systems? Is there any value in it?
Well, by walk forward, I'm assuming that you have a model, and then you're just seeing how it performs going forward in the future, which is always an exercise, but you run into that nebulous area of how are you going to be able to tell, what are you using for your criteria to see if there's deterioration in your model or not? Where is the cutoff point? It gets to be a very gray area. So you can do that to build up comfort level, but let's say on your walk forward analysis, it does start to go into a drawdown. How do you know that that's not just a drawdown versus the system, the characteristics have changed, So I don't know. I think that if you're a newer trader, maybe it might be beneficial, because every time I develop a system or a model, the very first trade I take with real money guaranteed is going to be a loser. It's kind of like Murphy's Law, Yeah. But I don't know. Maybe if it builds a little confidence level, but it could also decrease your confidence too if you didn't do your modeling in a very suitable way. As far as Monte Carlo, basically, I assume that you're talking about using the historical data and determining your standard deviation and variance,
Right.
So forth, and then building a probability grid to see going forward. Is that what you're talking about? Okay.
Yeah.
And the only thing to keep in mind with Monte Carlo simulations is that type of modeling is based on a normal distribution, you see, and the markets don't have a normal distribution to the standard deviation, right?
Yeah, exactly.
So you have to be aware of that. Again, it could just be an exercise. For me, there wouldn't really be any value in it, because I know that whatever modeling you've done, the extremes are still to come. If it says that, your model or your system only had a 10% drawdown, well, there's going to be a 20% drawdown at some point, So it's a little bit delusional, but I think as long as it, if it's an exercise in helping you keep an open mind, that you don't know everything, because normally human bias is that we want to be overly optimistic in our ability to predict things, right? We always think that we're better than we are. We always think we know better or can predict better than we can. So perhaps if somebody did that type of exercise going through Monte Carlo simulations, it might open up their eyes that, wow, there could be a lot of variables here that I didn't think about. I should, maybe I'm being too rosy in my assessment of my models or my abilities. But on the other hand, just be aware that it's a very artificial constraint, and it's not how the markets operate in the real world.
Do you have any favorite strategies, setups, entries, exits, and so on? You've already mentioned breakout strategies. Is there anything you're using, let's say, on your daily basis?
Well, everything I do is technical, and it pretty much falls into one of three categories. It's going to be a continuation pattern or a reversion to the mean type of pattern where you've got a loss of momentum or a breakout from a chart formation. And I have to say, honestly, breakouts are my least favorite strategy, because there's always a lot of noise and gaps and uncertainty, and it puts pressure on you to immediately assess things in a different way. But I think that I don't really have any favorites. I like doing things where I can just catch a swing that's just turning, where the tide is going in or the tide is going out. I like to catch it where that tide is really starting to come in, or the tide is really starting to come out, and that's not bottom fishing or picking a top, but it's like something's rolled, and we're just ripe for that flush, that flush of all the longs, or something's sort of found a base and perhaps is just ripe for a squeeze of the shorts. So, that it would be something that perhaps would be able to capture more of a trend day. I like being able to catch a trend day, and you might only get 2 of those per month, per market, but those are a great feeling, because once you've caught the tiger by the tail, all you have to do is ride it all day. I don't want to take it for granted that it's going to close on the opposite end of the extreme, but you sort of know when you got the whole thing right, and then it's just a matter of, can you increase your leverage on certain spots?
Sure, thank you. I want to go back a bit more to the system trading. Do you think that system trading as such may be profitable? I'm asking that question because I know that you don't, I don't know if it's a good word, don't trust entirely mechanical systems. You just want to have a control on every single trade you make. So do you think that system trading may be profitable?
Yeah, absolutely. I'll have to tell you, I don't know of any trader that's making a good living trading a mechanical system. Okay, so I'll just put that out on the table. I know a zillions of traders. I don't know of anybody that's making a great living for themselves over like a 5-year to 10-year period. I mean, obviously in the last couple years where you've had an environment of exceptional money flows, you could have people that, oh, wow, it's easy. I've kicked, done very well in the last 3 years. But I don't know of anybody that's just doing a mechanical system for their own account 100% mechanically for the last 10 years. And I know a lot of people. It's not that I don't trust systems, okay? There's several problems with systems that people don't recognize. And that the first is they have much bigger drawdowns than people think. It doesn't matter if it's a simple volatility breakout system, if it's a trend following system, if it's a scalping system or reversion to the mean. I mean, you could have a system and it has 80% win-loss ratio, but it'll still have 6 losers in a row. I mean, that's a given. The stats will show that. So you have to be very careful of the leverage that you use trading systems, whereas I can increase my leverage on a discretionary basis with a lot more aggressiveness than I would ever do on a mechanical system. And that's really where the money's made, is when you increase your leverage and go in for that big kill. It's kind of like playing tennis, for half an hour, rallying with your opponent and just waiting for that one opening where they trip or they're pulled off court, or they make a bad shot. And then you can go in and put that ball away. You see, you can do that on a discretionary basis. I know that, like, when there's an opening, you can go in for the kill, and you can't do that with mechanical systems. So you don't want to trade them on very high leverage for starters. They do have big drawdowns. And the second thing is that they're a lot of work. People don't realize how much work they really are, because to do a mechanical system correctly, you really need to do it across either a basket of stocks, or futures markets. For example, if I'm doing a volatility breakout system, a sort of generic, enter one day and exit the next day type of thing, you're going to have your best success doing that at least on a minimum of 12 markets. And then that's a lot of work. You've got 24-hour markets. Are you going to put the thing, up so that it trades while you're sleeping? Do you need to check the fills to make sure that something truly got entered or exited where it should? There's also problems with the scalability. The shorter the duration of the system, really you can't start doing too much size on some of these things. Like a volatility breakout system, you're going to have to start dealing with slippage or partial fills or a lot of different things that people don't really think about. And then you need to have multiple systems. If you're going to just do one type of style, you really need 3 or 4 different systems running concurrently so that you can help smooth that equity curve. Perhaps you have on one hand a trend following system where you have a long position working, but on the other hand you have a volatility breakout system which is of shorter duration, maybe 1 or 2 day duration, that could catch a downside flush, earlier than the stop would be on your long system, you see? So at least it's more like lifting the long trade and then reestablishing it at a lower level when you exit your volatility breakout trade to the short side. So, I mean, you can get into a can of worms into different things, but people far underestimate the work and the organizational skills to run that type of program well. So it just, it's a different type of business model for me.
Right, I understand. But do you think, Linda, that for someone who's just starting his or her, let's say, trading adventure, do you think that using systems is helping to be more consistent? I mean, consistent in terms of behavior?
No, I think 95% of the people can't even trade a system unless they are the developer of it. I'm certainly not going to take somebody else's system and have faith and confidence in their work. And the minute it starts to go into a drawdown, they're going to freak out. They don't know the stats. They don't know how long the drawdowns last. I think it's a great way to destroy their self-confidence. And I don't think you should ever take anybody else's system. If you developed yourself and you are fully confident, of the numbers behind it, and you're aware of how long the drawdowns can last, and the volatility and all the little subtle nuances. If there's big gaps, how do you adjust for that? How do you adjust for a lot of different variables that can happen? So about the only thing that I could say that would be of value for somebody would be a simple volatility breakout system along the lines of like Larry Williams did 30 years ago, or, where it's entering on range expansion, exit at the close of the day, or exit on the next day's opening, because it gives you a very finite rule set. You're not going to make a whole lot of money. You'll see how the market does have lots of whipsaws. It'll open your eyes that it's not easy, but it will introduce you to a lot of different markets, and you'll probably get very good at record keeping and execution. So that's about the only mechanical system that I would recommend. And I can tell you that 90% of the people still wouldn't be able to trade it. I can give you very simple rules, and I could tell you, okay, this is going to be up X percent at the end of the year, and most people would not be able to follow the rules.
Right, thank you. You mentioned that it's very important that the person using the system was also developing that system. We have now solutions implementing, for example, genetic programming. So basically, you have a data mining software loaded with some historical data, which is searching for trading ideas and inefficiencies on the market. Do you think that such software may be useful? I don't mean someone using this as a shortcut, but rather someone trying to use it in, let's say, a wise way.
No, because you don't know if it just stumbled across. First of all, any type of artificial intelligence, genetic programming, things that are not non-linear modeling, if you will. All these types of non-linear things are still a function of the questions that you ask. Does that make sense?
Yeah, of course.
So there's still a function of the questions you are asking it. Now, let me give you a hypothetical example. Let's say that the universe of dollars is $5 billion, okay? And let's say that $1 billion is evenly distributed between commercials, hedgers, small retail traders, et cetera, et cetera. And then let's say that you have $4 billion hedge funds, all right? So A, B, C, D, and that comprises the other $4 billion, who all have superior technology, connectivity, so forth and so forth. And let's say that each one of those billion-dollar hedge funds is using artificial intelligence, all right, to try and come up with their trading strategies. Now, what do you think is going to happen? Do you think that you're going to have 4 hedge funds, each worth $1 billion, making money, and all the little peon, billion leftovers between the commercials and the small retail and all this kind of stuff are just going to totally lose everything so much? No, of course not. All it does is it introduces just yet one more level of noise into the marketplace. I've seen artificial intelligence, produce extremely poor returns as well, extremely poor returns. And then you get a little bit of survivor bias, so that the survivorship bias that, oh, wow, maybe 2 funds used artificial intelligence and they're touting their horns like, okay, we use artificial intelligence and we produce 20% returns, but then it doesn't look at the other 50 that used it and came up with nothing and lost money. So I think people look at that like it's some panacea, and that's not true, because you're still mining the same historical data. So there's nothing new there, and maybe it can adapt to a change in an environment quicker, or maybe not. The markets have these big fat tails, and I think that they are helpful in terms of managing risk. I think that's really important, but it just depends on the rules that you've built into them too.
Thank you, Linda, for that. It was very valuable. I'd like to ask you now how markets changed within the last 3 decades regarding efficiency, setups, volatility, and so on. You already mentioned that artificial intelligence brought some more noise on the market. From your perspective, when you started at the beginning of the 80s, was it easier or harder than now? Do you have any conclusion here?
Well, I definitely over the last 3 decades, the market efficiency has increased enormously. So once the horse leaves the barn, that horse is galloping full speed till it comes to the top of the hill, and then it stops. So it's not going to stop and graze along the way and let you catch it. And so everybody's smart. Everybody is instant information. So the efficiency of the moves and the markups is as great as it's ever been. But conversely, the noise levels are much higher as well. So once the market starts to consolidate or is in a congestion zone, the bands, the channels, the ranges are much wider. And part of that is you have a broader spectrum of market participants on multiple time frames. You have everything from the, 2-minute algos to the, long-term commercials to the, all sorts of market participants. So the markets are very mature compared to what they were a number of years ago. And the more mature that a market gets, the higher the noise level. So, and I think that if a trader doesn't differentiate between these two states very easily and recognize that, they'll get very, very chopped up. And that also is another problem with your modeling, is that when you do model, you tend to lump all the data together. Okay, so if I'm looking back 3 years, I've lumped all the data together from the markup periods to the trading ranges to the markdown periods. And so a lot of things tend to wash out, and negate each other. And so it doesn't really give a true picture because it's very difficult to model the state changes on a timely basis. You see, like how do you judge right when something's changing from a trading range to a trending market? The only way you can model that is after the trend is a little bit established, right? But in the meantime, it does a disservice to what you think the market really, how the market is really operating, if that makes sense. So the efficiencies there, the speed, by which things are trading is much greater. For example, I can have resting buy stops in the marketplace, and I will hear them get executed on my trading platform before I see the price trade on the chart, okay, or before I see the price change on my quote board. I will hear it executed on my trading platform first. That's how fast and urgent things can unfold. So I think on one hand, trading is easier than ever because the average range is greater than ever. I mean, gosh, the opportunity is crazy insane. I mean, just huge ranges for everything compared to what it was 30 years ago, and I think that provides huge opportunity. But on the other hand, it could be much trickier for a newer trader because there's so much data and so much stimulus and overwhelming amount of information. I think it could be much more difficult for a newer trader.
Yes, thank you, Linda, for sharing that. I've got some more other questions. Are you maybe trading on Forex market?
No. I like trading the currencies a lot, but I use the CME futures contracts.
But on Forex market as such, you're not present.
No.
Okay, another question. Bitcoin. This is a very hot topic recently as well. There are 2 futures contracts available now on Bitcoin. Are you maybe trading any of them?
No.
Okay, that was quick. But it's very volatile market.
It's a stupid contract to trade. It's a totally bogus market. It's just a big fad. The spread between the bid-ask is hugely wide. The liquidity is terrible. It's not even going to be around 2-3 years from now. There's so many flaws in this product. It's a joke. There's going to be better blockchain technologies than Bitcoin. So I don't see any point in trading it at all. And do you see any future for Bitcoin, or just you think it's another bubble? No, it's not that it's a bubble. It's an early prototype model of what could be perhaps a better means of transactions. There's lots of different. Obviously, I think Ethereum would be more popular than Bitcoin 5-10 years down the road, and who knows what they will develop. But Bitcoin's very primitive and has so many flaws and security risks. And I think anybody would be totally stupid to keep your money in a product that could be hacked and you have no resource, no protection, no nothing. So, nobody's guaranteeing your money there. So I don't think it'll last. And, it's very, very costly. I can make a charge with my MasterCard or my credit card and it hits my iPhone in like 2 seconds. It's like, bing, this thing just went through. And Bitcoin, I don't know. It's not an instantaneous transaction. So
thank you, Linda, for that. Nowadays, especially young, inexperienced traders are exchanging some trading ideas over the internet. Some of them probably are trying to follow the crowd, I guess. Others, on the other hand, let's say, demonstrating what they do on the markets, sharing their trades, for example. Do you think it is an efficient, right way of learning to trade?
What, just looking at a mishmash of crap on the internet and trying to figure out who knows what they're doing and who doesn't, and who's really showing all their trades and pounding their chest and just only showing good trades and this and that and noise? I don't know. I don't think it's a very good way. I think it's a huge distraction. I mean, do your own work. Just all you have to do is study basic chart formations and, learn to see something for yourself. I mean, I don't look at the internet. I don't look at Twitter and all that crap, but if somebody finds that they're making money doing that, great, but I think for probably 99% of the people out there, it's going to disrupt their concentration and be a huge distraction. How can I watch the markets and study the charts when I'm trying to read what a zillion people are saying? I don't know. I just don't understand that.
Okay, thank you, Linda. So when you're trading, you're cutting off from all the stuff like Twitter, Facebook, and so on, right? You put this aside. You're focused on trading and don't want to have any distractions, right?
Oh, I think that's Pandora's box. I mean, I'm trying to picture somebody like Paul Tudor Jones reading Twitter. I just don't see that happening. Some big hedge fund manager looking at what the Twitter is saying. I mean, picture all your great traders out there and trying to picture them reading a Twitter feed. It just doesn't make a pretty picture.
Yes, so it looks as from one hand, it's easier nowadays with all the software we have, access to the internet and so on. But on the other hand, it's a Pandora's box, as you said, because it brings a lot of distraction and the information we can get there is mostly junk.
Yeah, I mean, the best traders I know don't say what they're doing, Why would you do that? Why would I tell somebody what I'm trading? Why would I do that? Why would I say, oh, I'm looking to buy the dollar here or short the dollar here? Why would I do that? Why would I say, oh, I'm long gold? Why would I do that? It doesn't make sense. I don't want people to know my position. I don't want them to know what I'm doing. So why would I want to read what somebody else is doing? What would their motives be for doing that? Is somebody paying them if they're right? No, they should be happy with their own account and their bottom line. I just don't understand, the motivation for somebody doing that. It's not from the goodness of their heart because they're trying to teach other people how to trade. It must be because they have a freaking huge ego that can't get satisfied any other way. I just think that trading is a function of concentration and focus. And I don't understand how you can concentrate and focus on your game plan and, and where the opportunity is if you're trying to read a string of gobbledygook. But, I don't know, maybe if you're 22 years old, you have a special gene in your brain that I don't. I'm older, so I'm old school. But, prove it to me. If you find that you've made money for 3 years in a row, trading off Twitter, then keep trading off Twitter. But I think it's going to hold people back. I just don't see real traders using that as a viable methodology.
Thank you, Linda, for sharing that.
That's my opinion only, okay?
I've asked this question because I see such behavior pretty often. To be honest, I'm also old because I don't understand well the idea behind all this social media stuff used in such a way.
Information information that comes out in print or type is already after the fact. Okay, it's already been discounted, in my opinion. It's no different than when we were standing on the floor 30 years ago and we had two tapes that would go across the top of the room, with all the news. Like, was it Bloomberg and Reuters? Like, one was, or Dow Jones and Reuters, and one was always 2 minutes ahead of the other. And I mean, you could see we would get orders into the trading pit. Like, they would want to buy or sell, a couple hundred options. And then we would see the news hit the tape a minute later. You see? So I am like really cynical when it comes to that stuff. It's not timely. Somebody has time to type it in and whatever. The big money's, it's history. It's not going to help you.
I want to ask you a question regarding what software packages you're using for building models and also for trading. Could you please share some details here with us?
Well, I have two charting software packages, and they're basically redundant with each other. I mean, all the charts that are on one look identical on the other. One of them is CQG, and the other one is TradeStation. And for me, that's always important because, when I'm trading large funds, and when I had my fund, and managing money, I have to have redundancy. So I have redundancy with everything, multiple computers, multiple softwares, multiple data feeds. That was always very important in my business plan. So I still use both CQG and TradeStation. If one of them has a glitch or is slow or hung up or whatever, I can always look at the other one. But I have to say this. The connectivity and the speeds, everything is so superior today to what it was 10 years ago, that I don't think there's that same urgent need like there used to be for the backup. But with that said, I have CQG and TradeStation, and then my execution platform, I use the Photon software through FuturePath, the Photon trading platform. Now that's just for futures because I find that it's faster than anything else out there. Photon Trader. And for me, I like to have an execution platform that isn't bogged down by layers of infrastructure and charting and this and that. So I can tell, like with my platform, I'm faster than any other thing that would have these layers of analytics and so forth built into them. If I'm trading stock, which I do a little bit, I mean, TradeStation is fine. If I do maybe 2% of my stuff, like stock, or occasionally an ETF, and my time frame is of longer duration, so I really don't need that urgency with the execution. And I think TradeStation has quite a variety of products that you can trade through it. So I think it really depends on what you're trading. If I were doing weekly options, I would probably use Interactive Broker. But there's it's a luxury nowadays. There's so many different options available to traders. But for just simple modeling, TradeStation serves my purposes just fine.
So you're using the easy language there as well, right?
Right, but I haven't done any fresh modeling for 7 years. I used to have a fellow that worked for me for 10 years, and he was just superior in writing code and modeling and doing all that stuff. And he'd do the portfolio analysis. His name was Nigel. So he was the one that wrote all the stuff on the TradeStation.
Okay. So you're still using the code written by him, and you're just modifying it if you need to, right?
Yep. Once you have a template, it's pretty easy to do your own thing.
Yes. So when you have plenty of switches, you can simply go from one to another.
Yep.
Okay. Thank you, Linda, for that. I read in one of the interviews from the past that you're a strong believer in the chaos theory. I'm mentioning this now because I'd like to ask you if it means that you don't believe in forecasting, especially the long-term forecasting. Am I right?
Well, there's two different schools of thought to that. First of all, I don't believe in predicting or forecasting markets, period. There's too many things that can happen the further out you extend your time horizon. There's too many new variables that could be introduced. I mean, North Korea could decide to fire off its nuclear weapons. Who knows? There's just too many different things that could come into play. I do think that it's much easier to look at a weekly chart than it is a 5-minute chart, because the higher the time frame, the less noise there is. So the cycles, the business cycles, those types of things can become more readily apparent. If you want to do cycle analysis or, have less noise, you need to have that higher time frame. But I don't think that anybody can predict. I think it's a misnomer to do that. I like George Soros's theory of reflexivity, that in general, markets will go further than you think they will go to the upside, and they will go further than you think they will go to the downside. And the problem is that once you hit certain pockets where you have positive feedback loops, nobody can predict how far that is going to go. So I absolutely don't set targets for certain types of trades that I'm in. I would prefer to trail a stop or scale out. If there are shorter duration trades, I don't trail a stop. I just exit where I think I should exit, and so chaos theory also is a little bit of a misnomer. I just think it's because pure chaos theory also can deal more with a closed system type of universe, and that's where you can make the case that there's fractal relationships and so forth. But again, the markets are a real dynamic system. It's not a closed universe, so it's like the weather, it can change and hit these little volatile pockets and that are just unpredictable. It's like trying to predict the path of a hurricane. We can have 5 models trying to predict the path of a hurricane with all our supercomputers, and they'll still get it wrong, So I think the emphasis on prediction is overrated, and the emphasis really needs to be redirected towards cutting losers very quickly. That's all I can say,
Okay, so if I understood correctly, does it mean that you may predict to some extent the direction, but not the magnitude?
No, you can't even predict the direction. I mean, you can say, well, the odds favor, that let's say we had 2 high to low days and we're in a trading range environment. Well, the odds would favor that you should have a low to high day, so it's just, a probability thing, which is, in my opinion, slightly different than predicting, because the minute people use this word predicting or forecasting, somehow it seems to get the ego involved, which is like really poor for trading, we can say that if you have a swing where you have an increase in the supply-demand imbalance, say, to the downside, and then a consolidation, the odds would favor that you have a second leg down in the direction of that supply-demand. But it's just an odds thing. It might be a 58% odds. But on the other hand, you could get a flush, a liquidation flush, which is just a big spike down, and then it comes right back up. So the minute you try and predict, you take away all your flexibility as well.
Thank you, Linda, for sharing that. I know that you were on the market when there was the crash in 1987. Actually, you were not from the very beginning, but eventually you opened some big position on the S&P futures. Since then, we had a few more crashes, like, for example, the flash crash from May 2010. I'd like to ask you, were you on the market during the flash crash? And in general, how do you see such crashes from the trader's perspective?
Well, it's so funny that you bring that up, because I've been writing a book. I don't know if I'll ever get it written, but it was basically trading sardines. It was like Fear and Loathing in the Financial Markets, describing how I have been like on the wrong side of every major outlier, because I remember like I put on like huge short positions. I had shorted like 600 S&P futures and 600 Russell futures on Friday afternoon, the day that the Fed came out and said that they were going to rescue Fannie Mae and Freddie Mac, before the whole market imploded, So I just put on my largest short position ever. And then that Sunday night, they were gapping 45 handles against me, on this news of the Freddie Mac thing. So I think I've been on the wrong side of a lot of things, where it's been these outlier things. I actually traded the flash crash. That was kind of funny. I mean, I can remember every single tick because that the price was selling down into the 20s, which was like a level I had targeted where I'd looked to be a buyer, and I started to nibble. I had bought some futures, and I had my trading partner. This is when I had my hedge fund, and so we had bought like 100, and then I bought another 100, and the price was just kind of stalling out there. I like to try and see if the price stops going down, and then I can put my stop in, right? And I remember they were like around 28, and all of a sudden they just dropped to 22. And then they dropped to like 19, and my first and I hadn't even had a chance to put in a stop, right? This is like on 200 S&P futures. And my first reaction was, oh my God, there's been a nuclear bomb going off somewhere. So I immediately hit flatten. Okay, so I immediately flattened the account, which just is like getting rid of everything at market. I love that flatten button. So I flattened, and that cost me like another 3 handles. They dropped to 16, and then they went 05. They broke through the handle, 90, 80, 70, 60, all the way down to 55. Like it was like all of a sudden they were like 65 handles lower in like 2 minutes, So at which point, I watched it and I saw it start to bounce around a little bit and maybe make a few little higher lows. And I went back and I bought some. I put on a position again, half, and they came back. So I ended up basically at break even for the day after initially like getting clipped on 200 futures for like a good thing. But it could have been really, 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 really ugly. But that's why I say, if you make a trade, get your stop in right away, which is, something we didn't do with the fund because a lot of times we were trading size where you just couldn't necessarily put in resting stops on large orders in the marketplace, but that's why I keep my eye on it when I put the trade on. And that was really a testimony to my execution platform, which was the Photon Trader, the futures, that I use for the futures. That's through Future Path, because it did not have 1 millisecond of latency. For that whole thing, I did have 0 latency. So I think that was incredible testimony to that. But yeah, I think I've gotten caught in everything under the sun, from 9/11, I had positions on when 9/11 happened, and I don't know, you name it, I've been in it, usually on the wrong side, but I'm still here.
So you have a special button which is closing all the positions you have on the market, right?
Sure. I can flatten my portfolio, or I can just flatten an individual position. A lot of different platforms have different words that they use. I think they all have the ability, though, close position, close a, portfolio. I don't know. Mine just says flatten. I had my programmer just call it get flat. So I sometimes do that if I feel like I'm losing my roadmap or I'm through for the day. Sometimes I look at, where you're up a certain amount, and then I can start to see that I might be getting just a little tired. And I'm like, okay, get flat everything, and then I just lock in where I am.
I'm asking also because I often see on the internet that men like to be a macho type in trading. Do you think that women may have some advantage here over men being more composed? Or maybe there's something like woman's intuition?
No. I don't believe that. I think that shows what sites that you're visiting there, okay? Because I have a number of friends, we have a little Skype group during the day, and, there's like 2 other women and 8 guys. It's not audio. They just type away and stuff. We've all known each other for 15 years, and I can't say any of the guys are that way. None of them are macho, chest beaters, ego, or whatever. Everybody's sort of jokes around a bit or is pretty cut and dry. One was a nuclear physicist, another one was, a data engineer. Everybody comes from different walks of life. And I don't see that men are, macho type in their trading. I think that maybe you have a bias built in to the types of people that are posting on Twitter or the internet, right? That they might be more macho, and those would be the types that would mouth out there on the internet. But maybe that could be just 1% of the male population of traders out there. You see? So numbers and statistics and biases are very deceiving. And I've seen women who are stubborn and women who are quiet. There's just not as many women that are vocal, but I do think that you have to have a fairly strong ego or sense of self to be a trader, whether you're male or female, because it takes a lot of gumption and confidence to go out there and put your dollars on the line every day. It's not for the faint-hearted, but, the people that like to pound their chest and brag about their winning trade, I always say the reason they do that is because they have so few winning trades that when they do make one, they have to let the world know about it.
Thank you, Linda. Do you think that anyone putting enough effort could replicate your trading methodology?
Oh, yeah, my trading methodology is really basic. It's about as basic as it comes, it's tape reading and having your model. I think that it takes organizational skills. It takes time to do your homework at night, your game plan, your preparation, and anybody can copy exactly what I do. I've had people, I print out this trade sheet at night, and I've had other people fill it out, and they'll basically replicate the same comments that I do. So it's pretty straightforward. I just think that it comes down to the preparation, the organization, and the concentration and the focus. If somebody is lacking in their preparation or lacking in their concentration and focus, I just don't think they're going to make it as a trader.
So how much time you need to spend before a trading session to be properly prepared?
Well, I do my homework the night before, and I spend like a solid 35 minutes. That's just writing out my plan for the next day and what I'm going to do. Then the next morning before I start trading, I take about 15 minutes, and look at the hourly charts and see what the overnight action was, and then review, where the opportunities might come for the day. And, on the weekends, I usually spend an hour or two just looking at the seasonals or commitment of traders reports or, weekly charts, just general stuff like that. So it doesn't have to be so consuming. When I was trading my fund, I would, at the end of each day, I would log my numbers and do some sort of grunt work, and then that would always take an additional 30 minutes. So it doesn't have to be overwhelming. It's that you have to have a consistent process. And that's what people neglect. They don't have a consistent process for how they approach their homework, for how they execute their trades, for how they start their day. You have to have a consistent process.
So you have a game plan prepared the night before, right? Then on the next day, you know more or less what you're going to do. Am I correct?
Well, I have my sheet that I printed off the night before, okay? And it'll say, this looks like it's a buy day. This could be a shorting day, And then I go through each market and I'm like, okay, there's, I don't want to buy this because there's a daily sell divergence. So when that first starts to turn down, the first buying opportunity is going to be a bad one, So if I do look to buy, maybe the second or third day down. It's just for a scalp only, just like so I don't get caught up in anything. Or I say, okay, now this market here has come into balance. It's got 3 bars of price overlap, and I can't really predict if it's going to go up or down, but here, if it does start to break to the downside, here's like the area that it can trade to, or if it goes to the upside, here's like a good level to watch, to test. So I sort of stage it out. Is there a directional play that could come into play the next day, or should I just be waiting to see how the market tips its hand? That type of thing. And a lot of times the markets are a noise and there just really isn't anything, or they're strongly trending. If a market's strongly trending, like let's say it's been 6 days low to high, low to high, low to high, that's a very strong trend, a very good persistency of trend. So then I make note, okay, 6 days low to high, if there's morning weakness, that's a buying opportunity. Because trends don't end usually with a reversal in the morning. It would be more likely to end with a strong morning and a weak afternoon. So if you're in a strong uptrend and you try shorting the morning and the market hasn't turned yet, it's going to be a losing trade. So I make little notes, okay, if it's channeling upwards, I can still buy pull back to the moving average, that type of thing. But I have to do this when the markets are closed, because the next morning and with economic data and everything, stuff can get crazy, and it's too easy to get reactive, in your trading instead of thinking about being opportunistic, which is really where the advantage is.
Okay, thank you, Linda. Do you think that we are able to reach to the point where we feel confident and comfort, if possible at all, on the market?
Well, I'm not sure what you mean by comfort. So a lot of times the good trades are the ones that don't feel comfortable when you're making them. But I think that confidence is definitely something that improves with your preparation. So if you need to improve your confidence, I'd say don't do so many things. Learn to do one thing and do it well. Like learn to execute one trade only in the morning session and see that it's a profitable trade. Don't worry about how much money you make. Just say, okay, I made a profitable trade. I'm up money at the end of the day. It doesn't matter if it's only up $50. And do that 3 days in a row, and your confidence will triple that you are feeling in control and you're not going to do anything erratic or reactive, for which you will, have a conversation with yourself, because most people do things that arise from emotional states or bad habits, these types of things, and that's what erodes your confidence level. As far as comfort level, there's a lot of times in the market I have no idea what is happening, or where the market's going to go. You just have to be disciplined to be patient and wait for a spot where you see a recognizable pattern.
Thank you. Is there any pain threshold regarding maximum drawdown in your case?
Well, again, these things are tricky issues because maximum drawdown, that's going to be a function of your account size. So let's say I have $2 million in the bank account, but I only keep $100,000 in my trading account. Well, my drawdown comfort level is going to be a lot different than somebody that only has $50,000 in their trading account and they have no money in the bank account, you see? So it's that's why I don't like statistics like how much money did you make, what percent is your account up. They're very artificial because it's much easier to make 100% on a $10,000 account than it is to make 100% on a $10 million account. So anybody that starts putting out statistics out there, to me, just demonstrates their noviceness, in not really understanding what it's about. It's more important to ask yourself, if I'm trading, can I pay the bills? Can I buy food? Can I pay my rent? Can I put money aside for my kids' college education? Is this a viable way for me to make a living? And I think that those are better questions to ask. And of course, if a trader's only been trading for 2 or 3 years, they're not going to be able to do that, but they should be asking themselves, how long do I have that I can continue to work on my trading before I need to get a real job, or are my parents going to support me for the next 5 years? Or am I really happy doing this? In the big scheme of things, it's fun, but I'm really not making as much money as I thought I could make. Ultimately, I think that the real money is made when you get to the point where you can run your trading as a business, managing money. Then I think that's really where the big money is made. So I would say if anybody is, trading consistently with a 10-year trading record, they could probably be making 5 times as much or 10 times as much or 100 times as much if they were able to, start a fund, or, trade for a fund, take it to a different level, and I think that's really what differentiates the pros versus the retail traders. And there's nothing wrong with being a retail trader. To me, it is the greatest game in the whole world. It's absolutely enjoyable. Even if you don't make as much money as you thought you could make, it's a very seductive game. I like to call it a game. But if it's making you anxious and you're losing sleep over it and you're having too much stress, you need to step back and treat it as a hobby and say, I love studying charts. I love reading about technical analysis. I love designing indicators. And there's nothing wrong with that because there's so much room, in the marketplace for all different sorts of personalities and traders.
Sure. Thank you, Linda. Do you put a big focus on position sizing?
At the end of every quarter, I sit there and I do the position sizing based off the average true range. So I take the average true range for each market and convert that to dollars. So if the average dollar range for the S&Ps is $1,000 a day, and the average dollar range for, say, for example, silver or natural gas is $2,000 a day, and the average dollar range for corn, which is a small contract, is $500 a day, then I'm going to trade twice as much corn as I would S&Ps, and I would trade, half as much silver or natural gas in the sizing as I would S&Ps. So it's all a function for me of ATR, and then I keep that fixed. I keep that fixed for the quarter, and I can trade in half units. So let's say for me, a full-size unit is 10 contracts per $1 million. Okay, so if I'm trading $3 million, I'll trade 30 contracts. If I'm trading $1 million, I trade, whatever, I've got it set at for that particular market. But I can also do half units. So let's say, for example, that I have a position on in the NASDAQ futures and the S&Ps. Well, they're fairly correlated, so maybe I'm not going to put a full unit on, So there's I watch the correlation a lot, but I try to keep a very fixed entry size, and then usually I don't put on a full unit. Like let's say my unit size is 6 contracts per $100,000. Maybe I'm only just doing 3 contracts per $100,000 until I see that the volume's here, the opportunity's there, the opponent's pulled off court, boom, then I go in and I put on a full position. But that's usually the exception, not the rule.
Okay, so basically you're using volatility and correlations. They play the key thing to you, right?
Well, you have to be aware of correlations these days, because if I have on short 10-year notes, short bonds, short boons, short gold, short yen, they're all fairly highly correlated. So I have a pretty big bet size on there. I better be aware of that.
Thank you. Are you also involved in some long-term investments using, for example, stocks, bonds, or ETFs?
No.
Do you see a problem with being isolated from, let's say, the external world when we trade at home?
Well, I think the problem is, for me, it's temperament. I always had people working for me, like a trading assistant, and when I had my fund, Nigel was there doing all our testing. I had Judd help with the order execution. He was just great eyes and a great trader, and it was slow. We'd sit there and talk about movies or joke, a lot of humor, stuff like that. So I miss that. I miss that a lot. It's hard. I can see how an individual person could get really, really bored, or turn to Twitter feed or have the TV on or start surfing the internet, which just end up being distractions. So, I mean, what I did is I have this little group of friends on Skype, but we don't do audio. They tend to type a lot more than I do. I'm not really a typer. So, everybody's known each other for a long time, so they tease each other or post links into jokes at lunch or silly stuff, just silly stuff, which you need, to keep the stress down and stuff like that, joking around about their mother or this or their girlfriend or their date, it's so I think you need some type of interaction, but you have to be, it's a tricky thing. It's tricky. In my perfect world, I would have another trader in the same room, and they don't even have to be trading the same markets that I do, but it's just fun to be able to chit chat during the day. Oh yeah, like when it's slow, what do you feel like for lunch? That type of stuff.
Okay, thank you, Linda. We are getting slowly to the end, but let me ask some more questions. How would you comment general opinion which say, for example, that technical analysis doesn't work or that looking at the charts is pointless? How would you reply to such opinions?
Well, I mean, they're somebody's opinion. It's everybody's entitled to their opinions. I mean, charting and technical analysis, again, it's not a forecasting tool. It's not like you do Fibonacci projections and say that the price is going to go to here. Technical analysis is, it tells you where the risk is. It tells you where support and resistance is. I don't know how you can fault that. I want to know where support is and if that support starts to get broken, or if the market's accelerating or it's losing momentum or if it's starting to consolidate in a chart formation. That's what charting is, and that's what technical analysis is. So it's assessing the current environment. Is it trending? Is there a supply-demand imbalance? Is volume increasing? I would say it's about as basic as you can get.
Okay, thank you, Linda. We are getting slowly to the end, but let me ask some more questions. How would you comment general opinion which say, for example, that technical analysis doesn't work or that looking at the charts is pointless? How would you reply to such opinions?
Well, I think you start with one market. Just pick one market only. I don't care what the market is, and then I think that you have to learn execution, because what will happen is if you've never done it before and the minute you start to make a trade with real money, I guarantee your heart's going to start beating, your adrenaline's going to increase, it's a very unsettling experience. It's kind of like jumping off a high dive into a pool, but it's at night and you don't know how far that water is below you, right? So I think that you have to sort of desensitize yourself. So I would just pick one market and just get a feel of placing an order, placing a stop, exiting after a minute, just to get the feel of going in and out and not worry about making money. I think you have to do that right away. And that could take like a number of trades to sort of get used to it and build up a comfort level there, and from there, it's just a matter of getting to know that market a little bit more closely. How does it open? Perhaps, study a little bit about auction theory or, different swing trading, understand looking at the highs and the lows, the Globex highs and lows, or the highs and lows from the day before. How does the price trade around these levels? If you wanted to do some basic modeling, what percentage of the time is it going to trade above the high or below the low or outside of the Globex range? And just sort of build on it from there. Maybe if you're just starting out, look at a 5-minute chart and an hourly chart and kind of get your bearings, pick one moving average and one oscillator and learn to follow the market, do some basic tape reading, watching how the price goes up and the price goes down, maybe doing a little paper trading or, as the price is coming down, write down the price level. It's going 27.50, 27.49, 27.48, 49, 48, 49, and note the way that the price starts to change and trade, when it's finding support, and just really, really basic stuff, stay away from stupid stuff like Fibonacci and Gann and all these projections and ratios and nonsense, I mean, the big money is absolutely not made that way, I just try to picture Paul Tudor Jones doing that stuff and you'll have a good laugh, it's just not done that way. So anything's helpful. I don't want to put down any tools because anything that makes you look at the charts closer can be of value. That's absolutely the truth. But I mean, I can tell you, I've seen people for like going on 40 years and who makes money and who doesn't and who makes the big money, and how they're doing it. And they're not using Elliott Wave and Fibonacci, but those could be just helpful tools in terms of familiarizing yourself with structure, waves, the way the market swings up and down and so forth, and just get it out of your head that you're going to be able to tell where the price is going to go, and what you need to do is just learn to immediately cut your losers super short and learn good risk management. I say that's the most important thing. The winners will take care of themselves. You just need one big winner out of every 10 or 20 trades. They'll take care of themselves. And then you have small winners and small losers, small winners, small losers. And then the cardinal sin is never, never, never have a big loser. And if you can go through your trading and your year and never have a super big loser, you will be 5 times more profitable at the end of the year.
Thank you, Linda, very much for that valuable advice. Okay, it seems that we've covered all questions prepared for today. Do you maybe have anything you would like to mention before we finish today's podcast?
No, I just say that, have a lot of patience. It really, I've never seen anybody make a successful living without at least 3 years of study. It takes a long time. If you were going to become a medical doctor, what you do 4 years of college, 4 years of medical school, another 2 years of specialty. Then you have to do your internships and, on and on. It's like a 10-year process. And people think that they're going to be able to be successful traders after just 2 years. And it doesn't work that way. It's just because there's so many different environments and, changing types of products and a lot of variables. So just have a lot of patience and don't be hard on yourself. I mean, I make a million mistakes every day, all the time. The worst mistake you can do is not do your own work and your own preparation and your own game plan, but I have to say, it's like every day I learn something new. It's like the greatest education in the world. Every day there's new things, new companies, new business models, cryptocurrencies, whatever it might be. I'm like, what are the CDIs? What are these? What are those? And I feel like I have a PhD in every area, and there's still so much I don't know. So that's how I look at it. Like it's fun because every day is different, and you have to approach it like that it's so exciting because we're seeing constantly new patterns and new products and new markets, and that's it.
If someone would like to learn more about you or to get in touch with you, what's the best way?
Well, I have a website. I haven't posted anything for the last 2 months, but there's all kinds of research and articles on there. I think it's just called lindarashke.net. And there's a little form there. It says contact us. And if they want to send me a question, I'm happy to answer it. And there's some resources in there. I don't have any products I sell. I don't sell advisory or mentorships or chat rooms or do any of that. But hopefully I've got a lot of information on there for free for people.
Definitely. I was, Linda, on your website and I can recommend everyone to go there. It's full of very valuable stuff and all for free. So really great stuff. Linda, thank you very much for your time, sharing with us so many valuable stuff. I do really appreciate it very, very much. It was a great pleasure and honor to have you today.
Alrighty, you take care. there? It must be late there now. Is it like midnight, right? Past midnight?
No, actually, it's not that late, as we have 6 hours difference.
Ah, okay.
Yeah.
Yes.
Thank you very much for your time, and all the best, Linda.
Alrighty, you take care. Bye.
Bye-bye.